Hello, hello. Welcome back to another episode. Today we're going to do a shorter episode, just talking specifically about some of the events unfolding in California, specifically the Los Angeles wildfires. It's a bit in our wheelhouse, obviously, and there's been a lot of questions and discussion, especially online, around the state of the market, what people can expect from their existing policies, whether they be commercial or part of the state FAIR plan. As well as, we could weigh in on our sort of predictions for the future and potentially some examples from our own backyard in Canada with respect to things like, auto insurance and other distressed sectors where people are really struggling to get the appropriate coverages for rates that aren't totally exorbitant. So with that, I'll provide a couple sort of background pieces, and then we'll go through a bit of a discussion around potentially lessons learned or, whether or not this was predictable, really. So the first one is, obviously, this is considered to be one of the largest, if not the largest fire in California. It's definitely going to be the largest in LA County history. Estimates I've seen are in the hundreds of billions of total losses. But in terms of insured losses, estimates are closer to about 20 to 30 billion. And that's partially because there's just it sounds like there's going to be a lot of uninsured or partially self-insured losses coming down the pike. But first and foremost, I think it's worth, again, talking a bit about the background of the California insurance market. Some of the questions around like what brought the state to this point. The big piece is going to be the intrusion of being able to set rates, in my opinion, at least. The intrusion of the state trying to interfere with private market insurance companies, attempting to set rates that are commensurate with the losses that they're paying. So the challenge that those carriers have is if you're paying out losses, so especially some of the wildfires we've seen in the state over the last 10 years, if you're an insurance company and you're paying out losses for these fires and you're not able to increase your premiums in the future to commensurate for those losses, those payments, you're essentially running a deficit, and you can't, as a for-profit company, you can't do that. So with that, any comments on, I guess, before we get into a bit more detail about what this specific fire has in store for people? Andrew, what are your thoughts on, the ability for, and I guess maybe the public disconnect, understanding what and how important it is for insurance companies to be able to charge appropriate premium?
Yeah, so with that, insurance is essentially a pool, right? Going back to what insurance really is essentially a pool of funds, a pool of capital that is kept aside to be paid out in case of a disaster. So when you're not charging adequate rates, so the people that are employed in this industry, in our industry in insurance, we are essentially responsible for charging adequate rates and ensuring that this pool is kept up to pay for disasters such as the wildfire. So when governments or when regulatory bodies come in and try to regulate pricing and not allowing the carriers to essentially charge adequate rates for these exposures, it's natural that these funds are going to go into deficit. So as the executives of these insurance companies, they're not running a proper pool. Like there's not going to be enough money to pay, and that leads to inadequate funds to pay, and then leads to bankruptcy of like these companies, right? Like that's essentially what happens. So adequate pricing is key, and is critical to making sure that there's enough capital there to pay out losses, and like you said, Kyle, to ensure that there's profitability for shareholders that are actually investing and putting money into this pool. So in my opinion, adequate rates are extremely important, and it should be up to the insurance company to set these rates.
Andrew, by the way, before I start, your hair looks fantastic today. Look at that haircut. I don't know if anyone's listening on audio, they're not going to be able to, we can't do justice with that haircut. You got to tune in to the video version so you can see Andrew's fresh new haircut.
Thanks, Mike. I don't get these compliments often, but
Looks
thanks.
good. It looks good. I'm jealous. But yeah, back to collecting the adequate rate. I guess I shouldn't be poking fun on a serious topic like this, but insurers are being vilified right now. A lot of people are vilifying the insurers. We're not here to defend the insurers. Like, obviously, this is an impartial conversation. It's not objective. It is objective, not subjective. So we want to make sure we look at both sides of the picture. Obviously, like you said, insurers they reserve capital, they reserve premiums to pay for losses, and they have to turn a profit. And maybe we could talk about what that profit might look different depending on the lines of business they're writing or depending on where they are geographically. But typically, an insurer wants to make it's not a lot of money. We're talking about cents on the dollar, 5%, 10% in terms of what they're looking to make on premiums collected. Is that average of what you guys usually see? 5 to 10% profitability on premiums charged, underwriting profit?
Yeah, I think for combined, I would say even less than that. Like, I think combined ratios generally are in the mid to high 90s. So I think most insurance companies would be happy with 5% profit on an annual basis.
There you go. So insurers are running off this 5% of underwriting profit. Keep in mind, they're also investing these premiums and getting a return on the investment of premiums. But from an underwriting perspective, they need to be profitable, and they have shareholders to be held responsible to. So at the end of the day, if they're not able to collect that adequate rate and gain that 5% of profit, they have to look at their levers. And what's their lever? Their lever is their underwriting controls and what they're writing. So they're going to look at what they're underwriting. They're either going to pass or reject, or they're going to put heavy restrictions on, lots of underwriting criteria in terms of what they can write, what they can't, or they start to limit their capacity, and they can only put up so much capacity in terms of coverage. So I think that's what we're seeing here in California. Kyle, you might want to speak to it more, but then we could talk about how similar things are happening in other places, like here in Canada, on other lines of business. But maybe you want to give more background there, because I don't know all the details on it.
Yeah, so I think the two that kind of surprised me that I didn't know before these fires, most recent fires, was I was aware of the restrictions on rate granting. So essentially, Prop 103 was passed in the late 80s in California, which it's not dissimilar to other legislation. So every state and province typically has an insurance type regulator that puts some framework in place in terms of how insurance companies enter and administer policies and so forth in the state, in the jurisdiction. So California was no different in that they regulated how insurance companies operated. Now, one of the things that they implemented that was, again, we see it in other jurisdictions as well, is the requirement to apply to a rate board or a bureaucratic desk at the state government to essentially approve their ability to increase premiums. And so that could be, for example, if you're paying $100 one year, they want to charge you $110 the following year. They have to apply and they have to justify to the state, to the board, what exactly they need that extra 10% for. And what we found in California was two sort of unique elements of this commission. First of all, it was led by a democratically elected individual. So there was already a bit of moral hazard associated with, if I want to keep my job, I have to keep the ratepayers happy. The other thing that was interesting was that there were an element of consumer groups that were allowed to intervene and essentially block rate increases. And so, if you imagine what a community interest group is going to do when a bunch of insurance companies come to town and say, "Hey, I want to charge you an extra 20%." because we've had this, catastrophic loss the last year, they're probably going to push back as much as they possibly can. Now, if they have veto ability, and I don't know the extent to which they were able to actually block these rates, but what came to pass was essentially these insurance companies were being outright blocked for years from increasing their rates, to the point where I read some anecdotal comparisons from California, large, very costly homes on the coast were paying less than a comparable home in, let's say, Ohio, where they have significantly less risk. There's significantly lower exposure, especially to wildfire. So there's no question that I think it can be said that they may have won the battle, but the long term, they're going to lose the war, because you can't, these, like you mentioned, these insurance companies are not going to play in an industry, in a market where they can't actually break even. If they're spending more than they're making, and we'll get to some of these recent lessons in other jurisdictions, including Canada. But the other one that I was surprised by, specific to California, is that the insurance companies were actually prohibited from using forecast modeling. And what I mean by that is they had to they were only allowed to rely on past data. So they couldn't say, hey, we predict that, for example, reconstruction costs are going to go up 10% next year. And we're anticipating we're going to see $55 billion in losses because of this increase in cost. So we need to try and mitigate that by, again, charging a higher premium. And anyone that was involved in construction or building trades or anything like that during COVID saw the price of lumber, for example, skyrocket. In some jurisdictions, it nearly tripled. And so if you're rebuilding a damaged home or a damaged building, your claim cost, your cost to the insurance company, is significantly higher as a result of those fluctuating commodity costs, those prices. And so for a large contingent of insurance companies to be prohibited from actually even studying it, like most actuaries and statisticians would argue that the entire business of insurance is being able to predict the future. The better you are at predicting it and predicting loss and the cost that comes with those losses, the better you are at being an insurance company, and the more likelihood you are going to have, again, to your point, Michael, a higher profit margin, still likely in single digits, but you won't be losing money in effect versus some of the other ones. So I think
they weren't able to use like predictive actuarial models for their pricing. They had to just go based on historical loss data to drive to basically justify the rates.
Exactly. So they were essentially trying to negotiate with their customer. Essentially, the customer had veto power or very close to veto power to prevent them from updating rates or increasing rates. And I would argue they potentially were forced to do so with one hand behind their back, because they weren't able to say, hey, look, this is what our predictive models are saying, because we're not allowed to bring that data to the fore.
That's an interesting thing. I wasn't aware of that, because that, to me, you're right. Like, that's the whole premise of insurance, is to have actuarial models to predict risk and exposures. I have a question about that. If they're not allowed to use actuarial model, and I'm sure probably all these insurance companies are required to buy some sort of reinsurance to protect them from catastrophic events like this. So if those reinsurance companies are running actuarial models and predictive models to calculate the rates, the reinsurance rates, and they deem that there's going to be a rising cost in reinsurance, now there's a gap. So, like, how can you compete? Like, your cost is going up, right? But you can't charge for that adequately. So that's essentially that gap. Who's responsible for that? Right?
Yeah, and this is a really good point. And I think it comes to the heart of the issue, where most people are quite upset about being canceled or non-renewed, or the media coverage around the eight of the largest carriers in the US either entirely withdrawing coverage from that state or significantly reducing their exposure in the state over the last few years. And that's exactly the reason. So what we see, from an insurance rate paying perspective, so let's call that like a person who's purchasing insurance, is you see the impact of reinsurance costs, to your point. So if an insurance company, for example, wants to spread their risk and they're buying reinsurance for a proportion of their portfolio, their exposure, if those costs increase, they have to be able to pass those costs on to the consumer. Otherwise, they will make a loss. And there are a lot of markets, there are a lot of carriers that are making losses. And again, it's not sustainable. No company can continue to pay more money than they make and expect to be in business. And so these carriers, these 8 carriers especially, said there's absolutely no way for us to close that gap. So we have to actually stop writing in the state. The other thing that I thought was quite interesting is after the fact, so after these fires have taken place, the governor announced on X that he was passing a bunch of essentially moratoriums, but one of which was that insurance companies that are currently in market and have exposure to these fires are not allowed to non-renew. So they're essentially stuck between a rock and a hard place where they can't increase rates. And there's potentially, if once we get into this fair scenario, there may be ways that they can increase rates if they're having to bail out fair stakeholders. But for the most part, they can't increase rates, and they actually can't now come off risk. So it's going to be a really difficult situation long term going forward, where there's going to be zero incentive for anybody to participate in the market.
Yeah, so the carrier's really stuck between, a hard place right here. Essentially, the reinsurance market is a global market, and they're not bound by the regulatory requirements of those specific states. So they, either you buy it or you don't, right? Like and without the ability to buy reinsurance for these catastrophic events, it makes sense that it's going to drive carriers out of that specific state because you're not
capacity dries up.
Yeah, they don't have the protection. It's like, why would you go in there without protection? That's just crazy.
Yeah, and just so our audience, I don't know how technical our audience is going to be, but insurers all participate in reinsurance, and reinsurance is basically insurance for insurers where they're spreading out that risk. So they're on a portfolio basis. Well, we won't get into all the details of reinsurance, whether it's on a portfolio or an individual risk, but for the purpose of this conversation, it's on a portfolio of business being California or being that region of California for these homes and property on the property side. So the insurers, it sounds like they couldn't really get adequate capacity from reinsurers. So they couldn't get to the point where they would be profitable based on the loss data, historical loss data. But are the governing bodies and these consumer groups not seeing the repercussions of pushing back on these things, such as rate freezes, all these restrictions you've mentioned, Kyle? Don't they know that, or aren't they educated to the point where this is going to affect our insurability? And without insurance, we're exposed to this type of loss. And it's not like these fires are new to California.
Yeah, it's a really interesting question. And based on the discourse that I've seen, I would actually predict that they don't, or they willingly choose to ignore it, because I think the overwhelming sort of perspective is that these companies are large companies, and there's no question, insurance companies are one of, if not the largest group of companies in terms of assets and capital on earth. The largest insurer globally, I believe, is AXA, and they have trillions of dollars on their balance sheet. However, coming back to your point about how they make money, it's in volume. It's very, very low margin, and in some markets and some products, they lose money. And so it's not that, oh, well, you've got a $1 trillion sized company, therefore you can afford, we don't need to pay what you guys want us to pay, because you're essentially just making money off of that. I think there's definitely a disconnect between what people perceive, how people perceive insurance to work, and the size and scale of the companies involved versus how the actual numbers on the ground add up. And to your point, if this is 100%, their decisions coming home to roost, where they simply don't have the capacity that they need. So one thing is, let's quickly touch on this FAIR program. So it stands for Fair Access to Insurance Requirements. This is essentially the for some of us will know it as like a facility or a pool, insurer of last resort, and it's run by the state. So it's not a private enterprise. And it's been around for a long time. I thought it was actually more recent than this, but it was originated in 1968. And really what it comes down to is just basic coverage. So anyone that's dealt with the facility for auto coverage will know that it's kind of bare bones coverage, and you're really not given a lot of options in terms of limits and types of coverage. So that's first and foremost. Now, FAIR have reported that they have total exposure. So this means that roughly if every single policy that they write in California, and this only applies to the state of California, were to come due to limit losses, they would have roughly $460 billion in exposure. So their total portfolio risk is roughly 460. Now, any company and every insurance company will have large numbers like that, but only a fraction will suffer losses on an annual basis, which is where the premium comes in. So they're not receiving $460 billion in premium. This is the total amount of those policies. However, what they do have in terms of liquid assets for exposure purposes is 200 million in reserves, or I've seen upwards of 350, but for the most part, their recent reporting says about 200 million. And on the reinsurance side, they've purchased or they have available a little under 5 billion in insurance. So if you take those numbers, let's say round up to 5.5 billion, in comparison to the exposures of 460 billion, you can see that this plan is probably going to be underwater, from these fires. So one estimate, Pacific Palisades alone, which was one of the major areas hit, was nearly decimated. I would say over 80% structures destroyed. So they have rough estimates are their exposures about 6 billion there alone. So that would wipe, if again, 100% is never going to be the case, they'll probably be closer to 4 or 5 billion, but that's still 90% of their total exposure and reinsurance coverage. So what ends up happening after, if they can't pay their exposures, if their liabilities exceed their reserves and their reinsurance coverages, then what ends up happening is that they pass on those liabilities to the remaining insurers that are still working in the state. And I think this is really pertinent to why so many other insurance companies left. It wasn't only that they couldn't get rate, but they saw the writing on the wall as well, that FAIR was essentially picking up every single person or most people that were being denied coverage because it was the insurer of last resort. And they saw that if FAIR was to be insolvent, the liabilities would be passed on via assessment or a special assessment to the other carriers in that market in proportion to the market share that they have. So if there was one carrier that wrote 50% of California, if hypothetically FAIR is on the hook for 20 billion of uninsured losses, they're on the hook for 10 billion in FAIR attributed homeowner losses. And so if you're a private company, if you're a private insurance company, that is going to be extremely, extremely difficult to deal with and come out the other end, fighting. And again, it comes back to, did the population, did the government, did the bureaucrats, did these commissions know that what they were doing was going to set themselves up for these sorts of scenarios? I don't think that they did. I don't think that they foresaw this type of an event. And I do believe that they sort of said, hey, we'll backstop it with private insurance capital if, something were to happen to FAIR. But those companies that this happens to, it could even wipe them out if that's the losses of that magnitude. And they definitely won't be, re-entering the state anytime soon to start writing more policies. So it's a pretty shocking and dire outlook.
It sounds like bad policy from the government level. I'm sure, I haven't done enough research into it, but from what I've heard, what I've seen, what you're talking about, there definitely was some mismanagement in terms of legislation, government policy. Some people dropped the ball. They dropped the ball there. They put the wrong policies in place. It pushed the insurers out. They inadequately funded this FAIR fund. And now look where California is left. So I don't know. What do you guys think? What do you think, Andrew?
Yeah, it's interesting because there's probably, like with the private insurer leaving the state, there's probably an increased reliance on this FAIR plan as well, right? And I'm not too familiar with the FAIR plan, but I'm assuming that the coverages are quite limited as well, right? So and the fact that they're passing on the deficit to the remaining carriers that are left in the state is shocking. It makes sense that private carriers are going to just leave the state completely, and to your point, Mike, it's these regulations that are really putting at risk the people, the resident, right? Not having access to a fair market in insurance is critical. If you want private carriers, or you want a private market in your state, you need to allow for fair pricing. What is the market willing to pay, right? It's just like it's a free market, and this allows the carriers to enter the market, and at least this provides, in my opinion, this provides an option for resident to gain access to insurance if they need to. Sure, in some occasion it might be too expensive, but I say this all the time: unless I have millions of dollars in the bank, I'm going to rely on that, that insurance payment on a monthly basis to protect me in the event of a disaster.
Mm-hmm. So what really irks me the most is these are positioned as consumer protection policies that are being put in place. It's consumer protection. We're capping rates. We're giving you a fund, a fair market fund to give you additional coverage. And really, all it's doing is putting them, at risk. There's no consumer protection here. No consumers are being protected right now. Where's the consumer protection?
Yeah, this is I get the consumer protection, but it just, to me, it's just, you're protecting. You're not protecting any consumer if the product is no longer available.
Yeah, it's ridiculous. It's ridiculous, right? And we see this happen in other places as well, and we see the impact it has on consumers' availability to this product. To your point, all of a sudden, this product is no longer available. A product that's gravely needed, especially at a time when we're facing all these catastrophic losses happening globally. And now, if you don't have access to this product, what good is saving, small percentage points on rate if you don't have access to the product?
Yeah. So let's just draw, we draw some parallels here. Like if we just look at healthcare, for example. Okay, this is a little bit of a, diverging a little bit off of the topic, but if we just take healthcare, for example, the States is all about private healthcare. Canada is all about, public healthcare, having access. And you see the two system, what strain it puts on the public system and the private system, right? Like you get the efficiency and the speed as you pay, but because there's private, private clinics and all these things, and then in Canada is all run by the country, but run by the federal government, right? So in essence, what I'm trying to get at is that you have to have that option for people to go private, and you have to have that public, but these things have to be managed very carefully, right? And if you don't want to drive out, like to what you said, Kyle, the fact that they passed that cost down to the carrier that didn't even participate in insuring a bad risk is essentially them taking profit from somewhere else and filling the cracks that they've created. So nobody's going to participate in that market. So it's quite interesting. I think there has to be a hybrid approach, and clearly California put together a hybrid approach that did not work, right? And there's a lot of improvement there, but at the end of the day, it's the regulatory environment that kind of caused all this. So that has to really change in order for there to be improvements and for carriers to be comfortable even getting back into the insurance space in that state.
Yeah. In closing, what do you think we can sort of suggest for purchasers, whether they be commercial buyers or, homeowners or whatever, if they're faced with either in the private market, increasing rates, or, unfortunately for places like California where they may actually not have ability to even get coverage. I know we're seeing in Canada, especially in the auto markets, there's a lot of distress, and especially commercial operations are struggling to get adequate coverage for, auto coverage, auto products. So, what sort of advice do we have for those that are trying to do what they can to keep their head above water despite all of these sorts of headwinds?
Yeah, that's a $1 million question. So I'll just kick it off. But yeah, we're definitely seeing this in Canada as well. When there's regulation that gets involved, a lot of bureaucracy, red tape, consumer protection that comes in place and starts, really dictating rates and acceptability of risks where the insurers don't have the choice to choose, on selecting certain risks, or charging adequate rate to remain profitable, which eventually pushes them out of the market, similar to what happened in California. So we are seeing that in Ontario and Alberta on auto for sure. Very recently in Alberta, but Ontario's been dealing with this for a little while now. For a consumer, very, very difficult to approach this as a consumer. I just believe that if you're kind of pushing or advocating for rate caps and you're pushing back, we have to realize there's a trade-off. We have to realize what's coming in the pipe. So there's never just, it's always a give and take. Think about it. Like if the insurers are going to give you, if anyone's going to give you something, they're going to take something away one way or the other. So if we're going to just start pushing rate down, if consumers are joining these advocacy groups and they're lobbying at Queen's Park to get that rate down, I just want consumers to be aware of the repercussions. So there's just two sides of the coin.
Mm-hmm. What I would suggest for the consumers is to educate yourself on insurance, educate yourself on what insurance is, and how it is set up. I think that's key, because the more we understand insurance, the more we understand how it operates and how it protects us as consumer. Essentially, like there can be a situation where we're seeing in Ontario where there's optional accident benefit already available, right? But people don't know what coverages are entailed within accident benefits. What are the protection you're getting? And then there's also the push for optional DCPD. What does that mean, right? Like, what does that mean to me? Sure, the consumer. The issue is that I think in our society and in the community is that we see that insurance as a commodity. It's whatever's cheap, and it's an expense. It's cheap. I'm never going to use it. But in that one scenario, when you need to use it, if it's not adequate, that's when it's going to hurt the most. And I think, to summarize it all, I think the consumer needs to be educated. The government needs to do a better job at educating the consumer on what insurance is and how it is being set up, and at least that it educates the consumer. Instead of trying to, to win votes by saying we're going to cap insurance rates, we're going to lower your insurance rates, and that all that is doing is just pushing out the private corporation, private insurer out of the game, and it's going to rely on government because there's no players left in the space, right? So I think
what kind of service they're going to get when it goes to government service. But I like that, Andrew. I second that. Education is paramount.
Mm-hmm. Awesome. No, well said, guys. Let's leave it there. So thanks for joining us for our second episode. Hope you learned something. Feel free to send us a line if you guys have any questions, and we look forward to chatting with you on the next one.